Please welcome the panel to the stage.
Good afternoon, everyone. It's a pleasure to be back here at the Milken Conference. It's always a stellar event. And I'm excited to dive in now in a key area of the markets. Direct lending has exploded onto the credit scene, transforming the middle market landscape and creating compelling buying opportunities for investors in the hunt for yield. I'm thrilled to kick off our conversation now with a powerhouse roster of industry experts. Cynthia Masri, Managing Director of Trinity Church Wall Street, Ted Koenig, Chairman and CEO of Monroe Capital, Timothy Line, CEO of Antares Capital, and Andrew Milgram, Chief Investment Officer of Marblegate Asset Management. Thank you all for joining us.
Thank you.
Thank you.
Thank you.
So I'd love to dive in and just understand a little bit about if each of you could share a quick overview of your role in your firm. Cynthia, let's start with you.
Sure. Good afternoon. It's great to be here. I'm Cynthia Masri. I work for the endowment of Trinity Church. Trinity is a historic church in downtown New York City, and the origin of wealth comes from a land grant from the Queen of England in 1705 when she gave the church 215 acres of Manhattan, which proved to be a quite valuable gift. So in terms of our endowment today, we still have about 40% in direct real estate. We also have a mission investment or an impact investment portfolio. And then the majority of our endowment is in a more typical allocator model where we invest in funds as an LP, and that includes to credit managers. In terms of my role, on the allocator side, our model is to all work as generalists. I also manage our impact investing portfolio, and I serve on the joint venture board that oversees our direct real estate.
Ted?
Great, thank you. Nice to see everyone today. My name is Ted Koenig, founder, CEO of Monroe Capital. Monroe Capital is a firm that specializes in private credit asset management, lower middle market. So think about Main Street America, 35 million EBITDA, size companies and below, credit facilities, mostly $250 million and below. We're the largest in this area in the country. We've got about 520 companies in our portfolio. We manage about $20 billion. We raise money from primarily insurance companies, pension funds, endowments, foundations. 75% of our capital comes from large institutions. 25% of our capital comes from the high net worth wealth channel, which is growing every year. It's been a lot of fun. I started the business 25 years ago. We were in the asset class before there was an asset class.
I called you the OG of this business.
OG of the business, not OG in life. But it's been a lot of fun, and I'm honored to be here today. Thank you.
Well, thank you.
Hello, everyone. I'm Tim Line, founder and CEO of Antares Capital. Have been in the business a long time as well. Antares was founded in 1996. We were originally owned by MassMutual and the management team. Then we were part of GE. The business was called GE Antares. And then about 10 years ago, CPP, the Canadian Pension Plan Investment Board, purchased the company. When they purchased the company, we were managing about $13 billion, and today we're managing a little over $80 billion across 485 portfolio companies. And we've raised quite a bit of outside money. So today, of the 80 billion, CPP is about 35 billion, and then 45 billion is from mostly institutional investors, but we also have raised money in the retail channel as well.
Wow. And Andrew?
Hi, everybody. My name is Andrew Milgram. I'm the Chief Investment Officer and co-founder of Marblegate Asset Management. We were founded in 2009. My partner, Paul Arroway, and I founded the firm. We focus on turnaround assets, special situation. So we buy credit that has been originated by others and then use that credit to restructure companies.
Great. Well, thank you all for giving us a bit of an overview of you and your businesses. And I want to kick off the conversation now with the $10 trillion question that's on everyone's mind in one way, shape, or form. And that is the tariff question, trickle-down effects on your business and your sector. And so, Tim, I'd love to start with you.
Sure. So if you think about the tariff impact, when I think about our portfolio, it's less than 10% of the companies in the portfolio that are directly impacted by the tariff situation, and that's just because we don't do a lot, let's say, in the consumer sector. So the bigger issue is the kind of other effects to the economy from the uncertainty, I would actually call it almost chaos, coming out of Washington that has led to significant uncertainty, decreasing consumer and business confidence. And so you've seen that's, I think, the bigger trickle-down effect. That's led to significant slowdown in M&A activity. I mean, we are still winning deals, but first quarter was actually kind of strong. Coming into this year, we thought that 2025 would be an unbelievable M&A year, and that's not going to be the case anymore. Could business pick up maybe by fourth quarter? Maybe, but there is this general view that let's wait and see. So when we talk to the CEOs of our portfolio companies, they're not investing. They're not making as many add-on acquisitions as they'd like to. They're not investing in significant CapEx projects because they're kind of looking at it saying, I'm a little concerned we may be entering a recession, and if we are, I'd rather kind of sit on cash than invest the cash. The only other thing I would say is for the direct lenders, even though volume right now is low or tepid, this actually plays to, it's beneficial for us because the broader capital markets right now are, there's very, very little happening. So when these deals are moving forward, the sponsors are generally wanting to use direct lenders to finance them just for the certainty of execution.
Cynthia, I saw you nodding.
So we have a little bit of a different lens being an LP, and I would say, I agree with everything that was said. For our vantage point, we think of ourselves as being very long-term investors, as do most allocators. And so while there is a lot of whiplash in the market, we try not to be distracted by the noise and really think about our long-term business and long-term strategy. And that is really a function of the asset allocation decisions and portfolio construction that has been talked a lot about internally, and the intention is you build a portfolio with a lot of different asset classes that can weather short-term market volatility and can weather multiple market cycles and over even short-term or medium-term challenges. And so I would say as part of your asset allocation, what you are ultimately trying to do as an LP is have resiliency within the whole portfolio, and whether it is specific asset classes or specific managers and the roles, that they can buttress or help support some of that volatility and create downside protection. And maybe that's because of particular asset classes and viewpoints you might have, whether it's your fixed income allocation and US Treasuries, and I understand putting aside questions now on whether that still is a safe haven asset, but whether it's there, maybe it's in your hedge fund book that creates some downside protection because those managers are running lower net or lower beta strategies. Or for us, we have so much direct real estate that we also have long-term leases with high credit quality tenants, and that income can help support or offset some of where we saw a lot of the distress in the past couple of months, which was really our global public equity book. I would say in this environment, despite us being long-term in the last month or so, we have thought a lot about increasing our cash. We've shortened our duration. Part of that in our treasury ladder, part of that as a more relative value risk-adjusted return viewpoint. Part of it is also just thinking about our organization and its spending needs, and in thinking about having our own dry powder of, do we want to be able to have, if there is more dislocation, the ability to be investing in whatever opportunity set arises. I would say from the LP standpoint, I anticipate that there will be more dispersion among managers in their returns and performance in this environment. So as context, private credit over the last 20 years or so has averaged about, the average manager is about 9% in terms of median IRR. The top decile is closer to 15%, the lowest decile is 2%, which is fairly wide dispersion, and that's not necessarily bad. You like to see dispersion because that usually means that there's an ability to generate alpha over whatever your passive benchmark is or whatever the opportunity set is. I could see that widening even further, which makes manager selection, which is a critical part of our job, even more paramount.
And so, Ted, what about the middle market? You said the lower middle markets is your area of specialty. How is that trickling down?
No, it's interesting. Private credit's been the fastest growing alternative asset class for the last 20 years. It's grown at a 16% compound return. And the reason why is because we've gone through 3 recessions, we've gone through a financial crisis, we've gone through high interest rates, low interest rates, we've gone through COVID. If you look at the shocks to the system, private credit has been the one place that institutional investors historically could hide out. Back in the years when our interest rates were 0, a tremendous amount of money moved from traditional fixed income into private credit because insurance companies couldn't underwrite 30, 40-year insurance policies. Pension funds couldn't pay a 7 or 8% dividend and cover their costs and cover their health and welfare costs for their participants. So there's a tremendous amount of capital that's come into private credit. And what's happened is that when I started this business 25 years ago, banks did 90% of the financing in leverage finance. 90%.
Wow.
10% was done by non-banks. Today, non-banks, firms like Tim's and my firm, we're doing 90% of all transactional finance, and banks are doing 10%.
Why is that?
Well, financial crisis happened, and what happened was that a lot of the banks failed. TARP was put in place. The taxpayers bailed out a lot of the banks. The regulators said, we're never going to have this situation again. So we're going to increase the capital charges, anything related to leverage finance. And when those capital charges increased, it became unprofitable for banks to do leverage finance. So all that got pushed out of the system. Now today, the question you asked is probably the question I get asked most often by investors all over the world. It's bad enough in the US. Think about if you're in Riyadh or Abu Dhabi or Seoul or Sydney and you're trying to make sense of what's going on with the economy here. We see it every day. We understand kind of some of the craziness or some of the chaos as Tim mentioned. We've been through a lot worse from a shock to the system. This stuff, it's noise. And unfortunately, private equity firms make decisions based upon 5-year projections. Companies invest based upon 10-year capital campaigns. So when you have noise in the system or chaos, it makes it very hard to transact. So we started out the first quarter very, very strong. Second quarter, we had a pipeline, so we're filling the pipeline. So if second quarter is going to be good, I'm concerned about third quarter because a lot of the transactions have been put on pause. From a Fortune 1000 company, 40% of the revenue comes from overseas. Our business, 2%. So we're very US-centric. Customers, suppliers, dollars. There's no foreign exchange issues. The big issue, though, is the indirect challenges, not the direct challenges. How it affects perception, money raising. We've got investors that said, you know what? Let's put on hold right now investments into the US. We did a transaction recently, and the Prime Minister, President of France, Macron, came out and said, no more investing in the US after the tariffs came out. Our friends in Canada, they boo the US national anthem at hockey games. So for us to upset Canadians is a really hard thing to do. And that's what's happened with all this craziness. So we have to figure out how to get back to equilibrium. And there's lots of different negotiating styles. You can sit down with somebody, say, this is what I need, this is what you need. You can sit somebody down one-on-one, go out of the room and say, let's try and come up with a deal. Or you can punch somebody in the face and then try and negotiate with them. That's generally not the wisest way to get what you want. And unfortunately, That's what we seem to have done. So you heard it this morning, the Treasury Secretary says, we have a plan, we're going to figure it out, everything's going to be okay, trust us.
Okay, so we'll see. Yeah.
The markets haven't exactly adopted that view.
Well, we got a little bit of time left, right, in the 90
Yeah.
days, so let's see where we land. So Andrew, I'd love to hear from your perspective.
Yeah, I share some of the views that the other panelists have outlined. In particular, I think the notion of uncertainty in the economy is causing businesses to not make decisions. They're not choosing to go left and they're not choosing to go right.
A paralysis, right?
Exactly, and there are three things I always say that don't do well with lack of motion. Airplanes, sharks, and markets. So,
That's a good one. I might use that.
and so I think that we are in this moment. I am less optimistic than maybe some of my co-panelists are about the consequences of that indecision and the impact it will likely have. Going into Liberation Day, middle market companies had on average produced negative net income for the last 2 years, net profits after tax, that is. EBITDA was on average down 40%. We saw a massive spike in leverage. The evidence suggests that companies in the middle market have incrementally added ABL capacity over the past year to shore up some of that working capital need. But this indecision is going to dramatically impact working capital. Most companies, GE has an entire building of people dedicated to managing working capital. Most middle market companies can't deal with these working capital fluctuations, and it will impact their financeability, their viability, and their capacity to manage operations. Post-Liberation Day, the post-Liberation Day economy is stagnant. We had a negative first quarter GDP print. It seems almost certain we'll have a negative second quarter print, so we will technically be in a recession. I think that it is important to think through how that will impact the psychology of the economy broadly, certainly the consumer. I think the last word is far from spoken in the trade dispute with China, and I think that there is a lot of confusion over what the time frame for resolution is. I think the Treasury Secretary this morning outlined a bunch of very compelling ideas, but one of the things that we always say at Marblegate is big ideas are easy and little ideas are hard. That is to say, anyone can have a big macro plan, and I am glad that the administration is starting to put some more form and substance to its macro outlook and how it wants to reshape the overall picture of the U.S. economy. But I do think that there hasn't been a ton of effort given to translating that into the individual decisions that companies will need to make to reshore operations, to recast their factories, means of production, distribution, what that will mean for investment and working capital. All of those things seem extraordinarily unanswered, and we start asking those questions at a moment of depressed earnings and extreme leverage. So I think from our perspective, the setup doesn't look great. I would echo the anticipated dispersion in returns. There are some terrific credit underwriters out there. I was just saying to Tim on the way in, we haven't seen his firm in a long time. There are firms that are doing great credit underwriting out there whose portfolios will perform well. In the main, though, I think we should expect a sharp deterioration in overall credit quality, which will tipple over a number of companies and will then obviously have consequences for investor returns.
So how does that trickle down to buying opportunities for your businesses right now?
For us, right now we are seeing lenders want to exit wholesale from companies' portfolios. I usually say, if 2-3 years ago, the starting offering price for every loan that we were ever shown was 80 cents. Didn't matter how good or bad the company was, the primary lender would start by saying, well, I'll sell it at 80 cents. Today, the starting offer is at 60. and
Wow.
transaction prices are substantially lower. But by the way, that tracks the average recovery for senior secured paper out there today is 40 cents. And so I think that reality has yet to set in on investors and allocators. We are seeing, again, business bankruptcies are at a 14-year high. This reality people should comport themselves to. There needs to be a real retooling of the capital structures of businesses. But another thing that we say all the time at Marblegate is businesses get the capital structures they deserve. And so that is to say, these are not capital structure problems today. They're operational problems. And so this will not look like 2008. It will not look like 2020, where a flush of liquidity from the monetary authority could paper over the problems. Here today, we have genuine operating issues that can only be addressed in a substantive retooling of how these companies conduct business. It will also require a financial restructuring, but we are going to see a meaningful reallocation of value out of equity to credit. There'll need to be compromise of the credits that are outstanding, which will involve meaningful reworking of ownership.
So on that point, so you're going to see more activity in the credit space is what you're basically saying, broad brushstrokes. But going back to direct lending, as we're seeing that direct lending boom continue, we've increasingly heard that people are moving away from the oversaturated mega deals towards middle market continues to get more crowded. So I'd love to get both of your perspectives because
Yeah, that's what, I mean, we just heard a lot of statistics. Most of those statistics were in the syndicated market, the wide syndicated loan market, where because of an overexcitement over the last several years in that market, documentation's been bad, leverage has been high. So when deals go bad, what happens is there's not a lot of workout potential. And in a low M&A market, recovery rates are down. And in that space, recovery rates are down today. You know, in the middle market space, so just to give you some perspective, there's three markets for credit. One is the syndicated market, which call it 100 million EBITDA size and above. Those are deals that get executed mostly through securitization, widely distributed. Next market is kind of 35 to 100 million. That's called the traditional middle market. Tim's firm plays there predominantly. We play in the lower middle market, the 35 million and below. In our market, we don't see that. It's one lender, we're the agent. We don't sell loans. We work them out. We sell the companies. There's no secondary market. There's no people that are buying up paper in that space. Recovery rates maintain historical levels. We're 85 to 80%. And that market has been really, it's been really good. And it stays consistent. There's, you know, recession every once in a while can drive default rates. We've averaged around a 1.5% to 2% default rate for the last 40 years in the space. You know, during the financial crisis, to give you a perspective, we got up to 6%, but recovery rates stayed relatively high. So loss rates tend to be low. You know, all that said, you know, perception's reality. When you don't have an active M&A market, deals sit. And as portfolios wind down, which is the biggest concern right now, I think, in the space, is that funds, like private equity funds, get old. You know, we do funds every couple of years. A lot of competitors do funds every year. And when you have a fund that's past its lifetime and you're winding those funds down, the question is, how do you do that within the fund period? At the end of the fund period, you've got assets. Either you sell the assets or you distribute the assets out. LPs don't want assets, they want cash back. So we're constantly looking at end of fund, end of life solutions for funds. And I think that's why this whole secondary market has grown so much.
Yeah.
Interesting.
Because we're going to see more and more of that.
Yeah, no, I was just going to say, I totally agree. We can get to the secondary market in a bit because I think it is a huge opportunity. But on the middle market and the upper middle market, agree with what Ted said, lower middle market, and they are incredibly strong market position in that under 35. We have a very strong position in that 35 to 100. We certainly finance companies and have many companies in the portfolio that are north of 100. Many of them have been in the portfolio with numerous sponsors for a number of years. But the firms that are the major players in that upper middle market, north of 100 million in EBITDA, most of them started in the core middle market. They raised such massive amounts of money that they gravitated into the upper middle market. And all of a sudden, those deals that used to be syndicated, companies that generated 120, 150 million of EBITDA, were suddenly going private credit, with private credit players holding, 800 million, $1 billion. We did see, because that market is competing more directly with the syndicated market, that the terms in that market were documentation was not as strong as it is in the middle market or the lower middle market, because they needed to compete with the terms that you would see in the BSL market. Now, what happened is, all of a sudden, the number of deals, the supply of deals in the upper middle market dried up. There was still availability of deals in the mid-market, so you start to see some of those players gravitate down into the middle market. And all of a sudden, some of the terms, like the EBITDA definitions, were looser and so forth. We're not seeing that much anymore, and I think you will see those players naturally gravitate back to the upper middle market, because with the amounts of capital that some of those firms have raised, it almost doesn't make economic sense for them to finance a $60 million EBITDA business.
It's a hard business.
Could I chime in on that
Yeah,
point?
please,
Only
please.
because I think that's an area that gets a lot of concern from the institutional, kind of the LP community, is the staggering amount of capital that has been raised and how concentrated it is, because it is not just that there's been so much capital, it is in an environment where is probably less deal flow and opportunity, that really the concern is, what is that doing to underlying credit quality? And so to put some context around the amount of capital raised, I think the last count I saw was there's something like 1,000 private global or private credit managers, of which 25% are new entrants within the last 5 years. So the number of new firms and the competition within private credit has grown significantly. And at the same time, the capital that's been raised by those GPs is so concentrated in that in the last year, 70% of the capital raised went to the top 20 GPs. And so it's really gone to kind of that upper segment of the market that Ted and Tim in particular have been talking about, in an environment where there isn't as much exits on the PE side, there isn't as much new deal flow. I think in 23, half of that deal flow was refinancing. Now, granted, maybe that favors the incumbent lenders, but from the LP side, a lot of that money has gone to a handful of firms. I don't think that's irrational. I think part of it is because there are so many LPs that are now more interested in private credit, and those allocations have increased. And I think if you are of a certain size, you need to deploy from an LP standpoint a certain check size, which will have you gravitate towards certain fund managers. And at the same time, I think it is probably a bit of a flight to safety in this environment, where if you are looking for managers with market-tested or cycle-tested track records and have been around pre-GFC, that also tends to favor the large platforms and some of these large institutions.
Anytime you get into a mature market, you're going to have three types of managers. Managers that are beta managers, that are taking market returns and have scale, aggregate scale. You're going to have alpha managers that are not taking market return, that are generating alpha from a select group of assets. And you're going to have those in the middle, a combination. That's what's happened to our industry today.
I just want to chime in. We've talked, there's a lot of discussion about deployment and sort of what I would describe as the technical aspects of the asset management business. I have to connect it back to credit quality. And look, the reality is that we are in a K-shaped economy where the larger the firm is, the more access to capital it has, the more resources it has available to it. But companies and individuals on the bottom leg of the K-shaped are violently sort of troubled. Ted's right, the broadly syndicated market is extremely tough. We've assembled a database of 1,200 companies in the middle market where we have complete financials. Now, the problem in the middle market, of course, is there's no central clearinghouse of information. And so when you start to talk about credit, people tend to rely on the anecdotal experience of their own portfolio. When we look broadly at the middle market, what we see is somewhat of a train wreck. It is a bit of a disaster zone. And the evidence for that, again, I can give you lots of statistics. EBITDA is declining rapidly. Debt service coverage ratios in the middle market, on average, are just above 1 times. So that is solidly double C credit quality. A full 25% of the data set shows a debt service coverage ratio below 1 times. That is to say, those companies simply can't pay their bills. And look, that's the reality of the middle market. There are good companies in the middle market that will survive and their lenders will thrive. Most companies in the middle market are deeply troubled. And we live in an economic environment which will exacerbate that trouble, not create an opportunity to rise out of it. I think when we think about where the economy heads, I think this indecision, as I referenced earlier, troubles everyone, but mostly troubles corporate managers who are dealing with the average EBITDA margin in the middle market is about 5 or 6%. The average EBITDA margin in the larger scale or public access markets is 14 or 15%. So we start with less available cash flow. We start with less flexible capital structures because these guys are right. They write tight documents. I've been knocking on Ted's door for 20 years trying to get him to sell me paper, and they won't. But that's not, again, that's not every lender here. It is by and large, people have been competing on documents. They have been competing on terms. And so what we see are worse companies with less quality documents, CEOs and management teams that have never seen an environment like this, and lenders who by and large don't have workout teams, don't have any experience in restructuring.
And on top of that, we're seeing more competition in the space, right, for the same credit quality for deals.
And most of the managing directors at those places, first day of work was sometime in 2009.
Right. To Cynthia's point, there are a lot of new entrants.
I don't necessarily agree with everything that you just said, notwithstanding I respect you very much. We've got 520 companies in our portfolio. I mean, we're the biggest indicator statistically of Main Street America.
And you do 100 deals a year, right?
And we'll do between 100 and 110 deals a year. So we'll put about $8 to $10 billion into the ground each year. And Tim probably does a little bit more than that because his deal sizes are bigger. But from a volume standpoint, very few firms do more deals than we do. And we see every part of the middle market industry. With the exception of consumer area, we don't really do much consumer. I will tell you that I have not seen any major trends in our portfolio today. We underwrite to about a little north of a 2 turn debt service coverage ratio. And we're probably today in our market somewhere around 1.6, 1.7. We don't see cash flow as being the big issue. For firms, what we are concerned about is elevated interest rates, because interest rates go up. That's the biggest driver of debt service coverage. Everybody can manage expenses. You can cut expenses. You can play with some of your internal overhead allocations. You can stop CapEx. You can do lots of things. But what you can't do is not pay interest, because that makes people like us unhappy. And when we're unhappy, good things don't happen to companies. So that's really, I think, the driver. And then revenues. We haven't seen any major changes in revenues yet, but that's what comes in a recession. And as a lender, that's what I'm concerned about, is if we start seeing forward curve signs of revenues where customers stop buying. Our portfolio is high degree concentrated in 2 areas. One is business services, software, and healthcare. Those tend to be the most resilient and the least amount, bless you, the least amount of issues.
Polite.
And so as long as you focus on core industries, now again, there's players that don't have the experience, there's players that don't have the infrastructure, There's players that don't have workout teams that will try and cut and run and sell for 60 or 70 cents to get out of deals. But that's just a function of the firm. And those are outliers. The core firms that have been around this industry for a long time, they wouldn't last for 20 years unless they're well managed, they do good deals, they drive good returns to their LPs, because LPs are sophisticated, more sophisticated today than ever before. I mean, you go to the Middle East, you go to Abu Dhabi, you go to Riyadh, you go to Dubai, these investors, they know everything about our market. They get reports. There's consulting firms that drive data and information. So I tell people our business is like a baseball game. It's good and bad. Every inning, there's a scoreboard, and you better perform every inning, because that scoreboard is going to tell your investors and the consulting community how you're doing.
Ted,
Okay, sorry.
just going back to your revenues point for a second, are you seeing consistent margins in the businesses?
The one area where we're seeing margin compression is wages. That's an area that over the last couple of years, we're very, very focused on that. And we're seeing wages start to compress margins. Now, a lot of our businesses, we don't do manufacturing. And for that reason, because we've learned in tough economies that you can't control that as well. So we've tried to find companies that are out of the manufacturing space. But I agree, that's one area where we're starting to see compression. Imports, tariffs, imports. We went through a period of time where companies were really good at driving costs down. They were importing from China, from Vietnam, from Malaysia. And I'm hopeful that I'm a globalist. I'm not an isolationist when it comes to things. That's what my big concern is.
So if you're seeing wage inflation and you're seeing stable margins, that means that you must be seeing an increase in revenues to preserve those margins.
Yes.
And so the question really then becomes about unit volume. And our hypothesis, again, what our data set shows, and it's 1,200 companies across a variety of industries, what our data set shows is that revenues are up, wage cost is up, and so companies are fighting to preserve margin that way. Yeah. But that means almost definitionally that they're selling fewer units. And so that decline in economic activity does have an effect that is cumulative across the economy. So as everyone has a lower level of activity, even if they're able to preserve margin, they are necessarily more operationally leveraged.
Definition of a recession.
Well,
That's why we're focused on, those are the forward indicators that you just mentioned.
Yeah, and so I think, again, I believe we are now in a recession already. The question is, how long will it go? And again, another question I would ask is, hasn't the middle market, our data suggests the middle market has already been in a recession. And I would point to, again, you have a portfolio that has been hand-selected by your team, and so it has a selection bias to it. Ours is an unselected data set, so it's just the data, raw. And so I look at our data set and I see confirmation in bankruptcy filings, which again, are sharply, steadily higher.
So I would say in the middle market, thinking about our portfolio, Andrew, and it's similar to Ted. Have some companies been impacted? Yes. You mentioned we do very little in consumer. We've seen some impact in the transportation and logistics industry, and then physician practice management businesses, which have impacted the entire industry, a little bit in behavioral health, but a lot of what we're doing is, our goal is to see all of the deals in the middle market, and we only close 4% of the deals that we're seeing, so we're highly, highly selective. When you were talking about kind of the number of deals that are in trouble, so we track our watch list, and we track it all the time. So right now, it's right around 16% of the companies in the portfolio are on our watch list. Now, watch list is not, hey, there's risk of we're going to be taking a write-off, we're going to lose money. It's companies are off of their projections, and then you work down. Certainly, there are deals where we're paying much closer attention because there is a risk of actually losing principal. Yeah. But there's not that many of those. The one thing I will say where we've seen a little bit of a change I'd say in the last 6 months, is we have actually done more debt to equity conversions where we've taken over as essentially
Right.
we and other lenders as the owner of the business. We used to maybe do a couple a year. This year it might be more like 8 or 9, and we're okay doing that. I think what's happened is some of these sponsors that paid 15 or 18 times for their company, they'll support it for a while, but if they're not seeing it, at some point they're kind of like, we can't step
Right.
up for another $25 million, and so we'll step in, and we've done that. But I'm not seeing, do I think that I'm very concerned about the economy right now? We're not seeing really concerning trends in our portfolio right now.
That's good. Well, Cynthia.
Tim mentioned something,
Yeah.
just want to follow up before. Tim mentioned something really interesting. Most people don't understand this and don't see it. The private equity business has become a very, very hard business. The days of buying companies at 5, 6, 7 times, doing a bunch of consolidations, growing those businesses and selling them for 12 to 14 times are over. You're buying platform companies today at 12 to 14 times EBITDA. Platform companies. Then you're trying to make acquisitions. If you're off and you can't grow revenues, you can't grow EBITDA, we're financing those companies. Our average leverage is about 4 times across our entire portfolio. So I don't give a shit about the private equity companies paying 12 to 14 times. I'm chasing 4 turns. And if there's a problem, or these companies blink and don't fix it, and these private equity firms don't step up, we're going to be there and we're going to encourage them to get out.
That's
a sale.
even better opportunity for you.
Yeah.
Well, Cynthia, I really want to fold you in here with the LP perspective. Help us understand the role private credit plays within your portfolio and how this has evolved. I know it's just one of your asset classes. You mentioned real estate, you mentioned hedge funds, you mentioned several others. And so I thought it's such an interesting perspective.
So I think the role that any asset class in private credit takes for an LP is a function of both kind of the unique characteristics of that institution and what they're trying to achieve and the objectives around it, as well as policy and asset allocations that's shifting to the market and for investment opportunities. So on the former, I mean, every institutional investor in their asset allocation is trying to meet their specific needs for whatever that pool of capital is supposed to achieve. And that can be also a function of what is that endowment or what is that LP's return hurdles and what are they trying to achieve there, their risk tolerance, their in-house expertise that they might have, what does their staffing look like, what is their time horizon, and that's how you start thinking about what is the role of every asset class. For Trinity in particular, because we have such a large portion in direct real estate, essentially kind of core plus real estate private equity, you can think of it that way, we place quite a high premium on liquidity and current income, which tends to be kind of how we think about credit generally, and credit for us sits within both opportunistic fixed income and within our marketable alternatives book, thinking about what the risk profile looks like. I think the second element of, how has it evolved for a lot of other LPs and really for the entire LP universe is how much private equity over the last 20 years has increased in an allocator's portfolio, and that's usually been accompanied with a decrease in the amount of public equities, meaning everybody's portfolios are becoming a bit more illiquid. What's interesting is as private equity has grown over that time, so has private credit. And even though there is so much focus on how competitive it's been in the amount of capital that has been raised in private credit, it is still a very small portion within a fixed income allocation or across a portfolio holistically. And so, one of the last studies that I saw had about 8% on average for an endowment is how much they have in private credit. If you look at US public pension funds, that might only be 3%. So it's still a tiny sliver of your fixed income allocation and a tiny sliver when you think about your overall portfolio. I think what has raised eyebrows is within that allocation of private credit, how much of it has gone towards direct lending. So in the last 15 years, direct lending has gotten from 9% of private credit to 36%. And that, I think, is what has raised a little bit more concerns around how much has been raised in this direct lending in particular.
Do you see that trend continuing?
I do, and I think part of it has to do with kind of these dynamics we're talking about for private equity. For some allocators, you might have your private credit within a private or a liquid budget. And so as you're making a relative value assessment of private equity and private credit, if you still want to have exposure to stable companies that are high cash flowing, that aren't going to have problems paying their interest, but maybe you're more concerned on what their revenue projections are going to look like, or we are already in an environment where exits have slowed significantly and distributions have slowed significantly for private equity, and so perhaps you want to be actually exposed in private credit versus in private equity.
I want to shift now to Europe for a minute. Conventional wisdom has been that Europe will continue to struggle with economic growth, so buyout opportunities are unattractive, but I'm curious as to what you all think, right? Because you mentioned most of your business is in the US. You mentioned not very much of your business is in the consumer sector, but interested to understand from the international perspective what at least some broad brush strokes are or top line thoughts.
I think, the middle market tends to be a U.S. phenomena. There's obviously an active financing market in Europe. Look, I mean, broadly speaking, for the past 15 years, we've been running massive budget deficits, which is stimulative. We've had a 0% interest rate environment that is stimulative. There's been this regulatory constraint on what banks can do. That has pushed things out into the private credit market, all in the United States. In Europe today, they are beginning sort of a Keynesian stimulative program. In the United States, we are literally reversing every one of the features that has defined the past 15 years. So we are now in an austerity program. The Treasury Secretary this morning said they're going to be expanding bank authority and bank capacity. They said we are cutting budget deficits. We are unwinding all of the things that have defined this massive wave of credit granting outside of the banking system. And I also think that we should realistically understand that there are things that are going to be presenting themselves in the United States that are important to think through. So for, say, less sophisticated credit firms than are here, what happens when there needs to be a protective advance for a dip? And you're out of your investment period? How will LPs react, particularly when that fund has underperformed dramatically? I think when we ask ourselves, sort of, where does where do all these companies resolve themselves? I think those will credit firms now be the permanent owners of these? Who will be the buyer and at what levels? I agree, if your attachment point is at the right place, you're probably fine. I fear that most private credit is not at the right attachment point, which is why we're seeing private credit trades as low as 50 cents now in the market.
Europe is interesting. It's a smaller market. There's a lot less depth than the US. Think of it as a 30 to 40% of the size of the US. And the challenge is when it's good, it's good. It's a very competitive market. There's lots of private credit players. Private equity's become a significant business in Europe. The challenge is when there's you want to get out, you want to sell, there's a workout. Here, the depth of the market protects you. If you're a very, very large company, you file bankruptcy. Bankruptcy gets filed, credit tends to get sold. Vulture investors come in. You have some investors that own the debt at par, some investors that own 80 cents, some that own at 50 cents.
I resemble that comment, Ted.
You put them all in a room, and they all fight with each other because the guy at par wants to get out of par. The guy that gets in at 80 cents wants 90. The guy that gets in at 50 wants 60. And you can't make everybody happy. In a middle market deal, lower middle market deal, we don't sell. We just get out. And we're getting out at par dollars, and we're holding until we have an exit at par dollars, because the market is deep. There's lots of companies, when you're selling a $35 million EBITDA companies, the 150, the 200, the $300 million EBITDA companies want you. There's always a way to pick up that for 50 cents on the dollar if I'm selling my debt at 4 times. Europe is different. You don't have the depth. So in Europe, when there's a recession or there's a problem, the recovery rates are a lot lower. There's a lot less options for lenders, and that's what we're going to see. And that's what we've seen historically when there's a downturn.
So we just have a couple minutes left, but I want to end with a little bit of a lightning round with this crowd. So we have 4.5 minutes. So looking ahead to the future, if you had to make one bold prediction about lending in the next 12 months, what would it be? Cynthia, let's start with you.
I would say from an allocation perspective, I think it'll continue to increase, and I think that is a function of, why is it that allocators want to be in private credit and why has it grown so much? And I think that you can still make those arguments on strong relative returns, especially compared to either public credit or any other private asset class, good downside protection and uncorrelated return streams versus your kind of major food groups, which is for a U.S. investor, U.S. public equities, and much faster distribution and return of capital than other private markets and other private investments. I would actually just say one data point on this, because I think it'll continue to be of just so much importance, as private equity in particular has had this slow realizations, and everybody on the LP side is very focused on DPI. If you think about private equity as venture growth buyout, kind of picking on venture for a second, if you look at the data, and depends on how you slice it, after the internet bubble burst, it took between 11 and 19 years for an LP to get 1 times DPI, meaning to get the amount of money that you contributed into that fund back, which is a massive opportunity cost, and I think that favors strategies like private credit.
Ted?
I think investors are going to realize that private equity is a much tougher business than anybody ever realized.
Which is good for you.
Which is good. I mean, allocations, it's all private assets. So assets are going to move from private equity to private credit. And the reason why is because, as Cynthia said, money's locked up, and you can't sell companies if there's no market to sell them. And these private equity firms are not going to sell them because they're not going to take the pain and sell them at valuations lower than what they have in their books. And IRR is particularly impacted by time. Time is the enemy of IRR. So the longer you're in these private equity deals, the lower your returns are. And historically, people expected a 12 to 15% IRR in private equity. Today, that's at a 5-6 year hold period. You make that hold period 8 to 10 years, that IRR goes down significantly, and all of a sudden, private credit returns are 11% or 12%, starts to look a hell of a lot better than a private equity return of 8% over a similar period of time.
Ted, actually on that, if you look at annualized cumulative returns from Q1 22 to the end of 24, private credit has outperformed private equity on average.
Yep.
Wow.
And
Tim?
I would agree with what Ted said. In terms of core direct lending, I think volume will be slow for the next 6 to 9 months. I'm pretty optimistic that volume will return pretty significantly in 2026 and in 2027. Just heard this statistic a couple days ago that one of the firms that does all the valuations for our firm, 3,000 middle market companies, that of the 3,000 companies they value, 60% of those companies were purchased in 2021 and 2022. So if you kind of look at, hold period on those and what's going on in the economy right now, I think you could see a lot of those exits in 26 and 27 once again, assuming that those companies have performed well enough for the exits. I think where there'll be significant opportunities for direct lenders is on the credit secondaries market. So private equity, Ted mentioned it earlier, private equity secondaries have been around for a long time. You're going to see that same type of thing where some of these LPs and GPs, for that matter, are just going to be looking for liquidity. And obviously, folks that are in the business and know those portfolios and know those companies well are the most likely buyers. So it's a pretty, I think that can grow at 20% plus for the next few years.
Oh, wow. That's a great return. Andrew.
Well, I agree with Tim. There's been an immense amount of activity over the past couple of years. So, you start from high purchase valuations, commensurate attachment points on leverage, and in the face of that, we have contracting margins, increasing rates, and uncertainty in the operating environment. I think you put all that together, and I think the trend going forward is to think of lenders as the new owners for large portions of their portfolio. I think that if you don't have the capacity to own and operate these businesses for an extended period, by and large, you're probably in a very difficult spot as a lender. And I think that we're likely to see banks re-enter the C&I, the commercial and industrial lending market as a consequence of all of that.
All right, banks are the new owners. No, lenders are the new owners, right?
That's right.
Yeah, lenders are the new owners. Well, we're out of time. I want to thank all of my esteemed panelists for joining us. This fascinating conversation on direct lending and middle market opportunities. Thank you so much.
Thank you.
Thank you.
Thank you.